we have reduced our forecasts by a couple of percentage points, 1.7 less than it used to be, but it's still a 2% growth. So I would highlight that, and I would highlight also the longer-term trends that should be now catalyzed by the Ukraine war, so that we can speed up the transition to a decarbonized economy.
There is a lazy assumption out there that when interest rates go up, when they're going up quite rapidly, even the ECB has given its signals to CMC and others this week as well, that actually the banking sector will make hay. I find that very concerning to have that as a lazy assumption, bearing in mind, yes, net interest margins can widen, but the fact is so can delinquencies, so can emerging market stress as well. So just give us a bit more of the subtleties involved in that conversation, because you've already just said we're taking down our expectations by a couple of percentage points.
Yes. So we have been operating, particularly in Europe, for now a few years with negative interest rates. That is very hard for a business because you start with a top line that is negative. So imagine that. Then you take the costs out, and then you might have some delinquencies, as you were saying. So the fact that we're normalizing, it's a very positive support for the top line. Will it have effects on higher cost of risk? It's very hard to know right now. It's very uncertain. We will have to see the effect. Inflation also has a positive effect in making debt less valuable, right? Because the earnings potential of households goes up as well. Right now, what we see is very, very solid risk metrics. So that combined with the good growth that we're still seeing, we're confident that the situation will be a net positive for banks as rates normalize. And even with higher inflation, with the clouds in the horizon, that we will continue to have positive results going forward.
The last crisis brought an NPL challenge for European banks. This time round, we're starting at a very low base on interest rates, clearly. But how vulnerable do you think the European banking system is from rising defaults, potentially, either corporate or personal?
I think it is very solid. So the situation now is not the one that we had 10 years ago, also because regulation has changed significantly, and including that we have different supervisors in Europe than what we had before, and also the frameworks coming out of Basel have made it so that banks have very strong capital ratios, with definitions that are even stronger and stricter than the ones we had. So in effect, we have more than double the capital that banks had on average. So that combined with very solid P&Ls and the risk indicators, as I was saying, that are behaving quite well, even if there is a deterioration, I'm very confident that banks can withstand and that we will not have a repeat of what we had in the financial crisis.
Are we going to see any significant change, do you think, to the face of European banking going forward? I mean, what have we learned recently? That Commerzbank and UniCredit did the dance yet again back in a few months ago, but nothing happened. As nothing happened back in 2017, or we've not had banking union yet delivered by the EU. I mean, are we going to see any cross-border merger activity? Are we going to see anything develop?
Two comments. First, banking union is very much necessary. And right now, there is discussions going on. The Eurogroup and the chairman of the Eurogroup, the president of the Eurogroup, Pascal Donoghue, is pushing forward with a very balanced proposal along 4 pillars. Very important that we have movement there in order to complete what's a half-baked banking union, which does not make any sense, that we have a single supervisor, but we don't have single deposit guarantee funds, and we still have the link with the sovereigns. We need to fix all of that. It's a complex issue, very much should be resolved. Now, M&A. I'm not going to talk much about M&A because it really bores me. I think...
There you go, Jeff.
That's a headline. That's a headline.
Because I think the future of banking has more to do with digital, innovation, sustainability. Steve was talking about those 3 things before. Digital, this has been already a big change. BBVA is already, and we're a large human-based organization, and we continue to provide a lot of personal service, but with more than 100,000 people working at BBVA. But it's the main channel of client acquisition. During the first quarter, 57% of our 2.4 million new clients came through digital. This is 5 years back was 6%. So from 6 to 57% in just 5 years, and this will continue. Innovation. Technology is changing the world. Yes, we see a downward adjustment in tech stock valuations, but that's more a correction. And there might be expectations that were overbuilt in certain sectors, interest rates now going up. I can understand the correction. But the underlying trend is there, that technology is changing the world. AI, robotics, blockchain. The disruptive impact of a programmable blockchain on which you can have digitized real-world assets, it's incredible. So the Web3, this is the future of banking. And then sustainability, of course, trying to decarbonize the world. If we had a decarbonized Europe, I'm sure Russia's actions would have been different. And certainly, Europe's ability to respond would also be different. So this is where we need to focus more than thinking about M&A, thinking about how we can continue to digitize, support our clients in the disruptive world that we're facing, and then also on the sustainability.